right, we'll go ahead and get started. We have a small group today, so we're taking it easy. We appreciate it. Let us know if everything sounds okay. So we had some unexpected, we had to restart the computer, and then the computer had to do a whole bunch of updates. So it took several minutes to get through that. I appreciate your patience. Really excited to have everybody here today. There's several people joining us online as well as here in person. And let's see, what announcements do we have today? We don't have a lot. As always, we'll remind everyone to silence your phones if you haven't. And you know what? The announcement I will make right now is that we have the holidays coming up. We will not convene as Museum Club in the first week of January. It's just too soon. And so we will get together though. So our first Museum Club in January will actually be an evening event. It is going to be the Playful World of a Toy Designer with Stephanie S. Kander, which we had originally scheduled for earlier this month, and then a snowstorm kept her out of Idaho. And so we'll be bringing her back. So 7 p.m. on Friday, January 13th, and that should be a lot of fun. Very prolific toy designer, has done some really cool stuff. Let's see. And I think that is essentially it for my announcements right now. Toytopia remains open through January 29th. We hope to see everybody here. But without further ado, I'm going to introduce our speaker for today, Connor Dye, a financial advisor, or is it a financial planner? Good. And I understand that these terms are synonymous, which I'm glad to hear of because I've always thought of them as synonymous, but I didn't. All right, good. Well, we'll learn more about that. So we've got Connor Dye here today from Three Peaks Financial. He is going to be talking to us about year-end tax and giving strategies. And just a little bit of background on Connor. He grew up not far away in Eastern Washington, but found his home here in East Idaho. First after spending some time at BYU Idaho and Rexburg, and then decided to settle here in Idaho Falls. He is married with 2 kids and can tell you a little bit more about himself. He has also worked in a credit union before joining Three Peaks Financial as a financial advisor. And we're really happy to have him here today. He is also part of the East Idaho Estate Planning Council, as well as other good things that Connor brings to our community. And without further ado, we'll turn the time over to him for his presentation. Thanks. Right. Sounds good.
All right. Thank you guys for having me here today. I think I put down, here we go, a little clicker thing. He gave a little introduction and I'll just add a couple things. What we do at Three Peaks Financial, we're a local independent financial advising firm. So it doesn't have the big name recognition of a Northwestern Mutual or a Edward Jones or things like that. But we have all the same resources because we hold our accounts with LPL Financial and all the same sorts of investment products, insurance products, and such that we use. So it's a local and I think a little less influence from all those big names and things too, which is good. A little disclaimer before I get into everything today. I have to make sure I let you know that this presentation does not constitute tax or legal advice because I am not technically a tax professional, and so anything that is a strategy that you're considering today, make sure you run it past and consult with your tax professional before you implement it. A couple other things. I wanted to also make sure you guys all know today that just for showing up and being here today, I appreciate you guys giving me some time. And so if you would like, I'm offering a free investment portfolio review or a financial plan review just as part of showing up here today. So I've got half sheet of paper here, and there's not too many of us. I think we should probably fill it out, or we won't even quite fill it out with people that are here. But you're welcome to put your name and email address down and a phone number if you'd like, and we can follow up with you after the fact. And also, if there's any questions, you're welcome to ask those as we go. I'm the kind of person that forgets. If I don't ask it almost right away, it leaves me. And so you're welcome to ask questions as you go. And then if there's a question, believe it or not, I don't quite know everything. I'm getting there, but I don't know all the answers yet. And so if there's something I don't know, then I can follow up with you after the fact that way too. So here's this. If you'd like, for follow-up purposes, you can put a name and any contact info down there too. So let's talk about our agenda today, about what we're going to talk about. So we're going to really quickly just talk about big picture, a little more than just tax planning, just to keep it in perspective. Talk about building a team around yourself to set yourself up for success. Then we'll get into some strategies for tax smart savings and income deferral. That includes IRAs, 401ks, Roth conversions, and RMDs. And I'll talk about all the acronyms mean as we go. And then we'll also get into some tax effective charitable giving strategies. And that's especially applicable to all of you. You guys seem like the kind of people that want to be behind good causes like the Museum of Idaho. So we'll talk about the best ways to do that out of each different type of account, an IRA, a taxable account, or if you just wanted to give cash. And then talk about the personal gifts exemption. And then we'll kind of sum it all up with some takeaways and have a little more time for questions at the end. So let's go ahead and start by talking just about financial planning. So with financial planning, it's a lot of different things that you all look at them together. What we're talking about today is one of these elements, one of the main elements of financial planning, which is tax planning. And tax planning is more than just looking at, okay, what am I going to be able to do this year to save myself the most on taxes, which we all want to do every year, right? But it's a little more looking long-term down the road about creating a long-term strategy about how to help with your taxes and such. So, but one thing we don't want to do whenever you're looking at one of the elements, you don't want to hyper focus on just that one thing and say, this is the most important. I don't want to look at the rest. What you want to do instead is look at all of the major 6 elements of financial planning. And if you look at all these pieces together, it's kind of like looking at multiple gears in a machine. They have to make sure they fit in together and work in tandem so that you can get the most out of that machine. And that's what financial planning is all about. So the best way to really do this is to make sure that you build yourself a team around you. And that means finding knowledgeable professionals that you can trust. Hopefully you've already done this, or if not, you're in the process of doing this. That starts with, I think we're a pretty important part of the puzzle here, a financial planner or advisor. Another good one is an accountant, and another good one is an attorney. And these, they're not the only professionals that you'll work with. There's people in all sorts of industries you'll want to have in your corner, but these are some of the more important, I would say, people to have as far as your finances go. And if you have these people working individually, it's going to be good. But sometimes if they're not working together, we can kind of butt heads. The accountant gets upset because you took the money out this way, and the advisor is upset because they're not being smart about this. And really the ideal way to do this is to have them work as a team for you all together. And that's something I'd recommend to everyone is, if you haven't already, build your team and make sure there are people that can work together and create some synergy that way. So let's get into the topic. We'll talk first about some income deferral strategies, and that starts with IRAs. So most of you, I'm sure, are familiar with IRAs and basically how they work. And so we're just going to go through this part pretty quickly, but I'll also show you some of the figures that are changing slightly in 2023. So for the year 2022, the contribution limits are $6,000 and then an extra $1,000 catch up if you're over the age of 50. So total of $7,000 that can be contributed in 2022. And if you feel like, oh man, I haven't quite done that this year, and you're able to, you can actually still do a previous year contribution up till tax time of 2023. So, well, tax time for 2022 or April 15th, roughly. So if you feel like, oh, shoot, I haven't gotten to that quite this year, remember, you still have that little extra time to make a previous year contribution. 2023, the limits are going up just a little bit. I don't know if you guys heard about this thing going around called inflation. I don't know what's up with that, but it's been going around. It's been getting around everywhere, and prices have gone up and everything. And so finally, they decided to increase the amount that we contribute as well to IRAs. Not a huge adjustment, but an extra $500 you can do, bringing the total to $7,500 for the year 2023. A couple other things you have to make sure you're aware of when it comes to IRAs. You cannot contribute unless you have earned income. And basically what that means is essentially employment income. So if you're not currently employed or getting some income that way, then putting into an IRA is probably not an option for you at this point. The big benefit that most everyone knows about putting money into IRAs is that you can deduct contributions dollar for dollar unless you or your spouse has a retirement plan at work and you're making above certain income limits. Those limits are found on the IRS website. I didn't think that having just a bunch of big tables all over the presentation would be super great. So I'll let you look into that if it's applicable to you. So that's IRAs. Yes. Earned income? No, it does not. Yeah. I know it's such a weird term, earned income. It's like, nope, you didn't earn that income. It's like, well, I did earn that income, but as far as taxes go, they don't really care. So good question. All right, next talk about 401ks, very similar to IRAs. And again, we'll kind of get through it quickly because it's a pretty familiar thing. The limits in 2022 were $20,500 plus an extra catch-up contribution if you're over 50 of $6,500, and that brings the total that you could possibly contribute in 2022 to $27,000 total. So pretty good amount, but again, inflation, that thing that's going around, what's up with that? They went ahead and made a big adjustment. In fact, this is the biggest adjustment to contribution limits on 401ks in the last 17 years. And they upped it to $22,500 and an extra $1,000 in catch-up contribution. So in the year 2023, you can do a total possibly of $30,000 contributed. So that's a pretty big adjustment. The main difference really between 401k and IRA, besides how much you can put in, is the fact that it has to be deducted from your payroll as you're going. So you can't just wait till the end of the year and then write a check out of your bank account. It has to be deducted from your payroll as you go. And here's another little difference here. It doesn't matter how much you're making with a 401k, you can deduct dollar for dollar with the contributions that you put in. So that's a little slight difference there. One more tip, if you happen to be still employed and you have a 401k, usually a lot of people get year-end bonuses or just bonuses throughout the year. And I've seen the tendency for some people to want to get their entire bonus. And so they put their 401k deduction basically down to 0%. And while that's great because you get your bonus all up front, a little tip is if you leave that 401k deferral on for your bonus, then that same matching, if your employer does a match, is going to apply for the bonus too. So you're missing out on extra money if you can afford to keep that deferral there in place for the bonuses. It's going to help you get a little extra into your retirement accounts. Any questions about IRAs or 401k contributions? Just some tax advantage savings. It's kind of like the first step. You make sure you take care of it if you're doing your savings. Okay, let's talk about Roth conversions. So this doesn't have to do with necessarily people that are still employed. It could be people that are retired or really any stage. And we'll talk about first the definition. So a Roth conversion is a transfer of cash or assets from a traditional IRA or 401k into a Roth IRA or 401k. And just to do a quick definition for you. Traditional IRAs and 401ks are tax deferred, and Roth are tax free going forward. You pay income tax on the Roth contributions when you make the money, but let me get into some limitations on Roth conversions. So you can take, as I said, traditional and turn it into Roth. The only limitations have to do with how much you already have in tax deferred or traditional IRA or 401ks. There is no actual limit on how much you can convert, but it has to come from an already established or what's already in your IRA or 401k. You can't take it money out of your bank and convert it into a Roth IRA account. So that's the only limits are just how much you have in tax deferred savings already. The big benefit is, well, in the course of the conversion, you do have to pay tax on any amount that's converted. It's 100% taxable, the amount that you do. But once that's converted, all of the principal and all of the growth going forward are 100% tax-free. It's good to have a mix of tax deferred and tax-free savings in your retirement plans, because if you do have a big expense, or if you have a big trip or something you want to do one of these years, it's not going to blow up your taxes that one year with all this extra taxable income. You can kind of manage it the way that you want to as you go. Some things to consider though before you do it is, number one, because of the fact that the amount that you convert, you can't have any amount withheld for taxes, you got to have some cash on hand to be able to pay for the taxes that this is going to incur. So if you're doing a big, especially a big Roth conversion, there's a big tax bill, you're going to want to make sure it's in a year that you have some extra cash on hand to be able to handle that tax. Another thing to think about, especially in 2022, has anyone seen the market doing something funky this year? Yeah, it's suffered a little bit, right? Stocks and bonds, I've heard a lot about it, trust me. It's part of the process. We understand that, right? But you also have an opportunity in these down years to do Roth conversions. The reason why is when the values of your accounts are lower, if you convert your money then, you're going to pay a lower tax based on a lower current value of those investments. And so this is actually a pretty good time to do Roth conversions if you're thinking about doing it, because you're going to have lower tax now. Once the market recovers and those investments go back up, you're going to have all that tax-free growth going forward. So not a bad time to think about it. Yeah. It still could be, yeah, because especially if you're not going to use the money for a while, you want it to still have some years of tax-free growth, then why not? And it doesn't make sense for everyone at all times. I mean, there are some tools that you can use, some software to do forecasting and see the impact of that, but you're not excluded from it being a benefit just because you're over, that withdrawal age. Good question. Kate, any other questions about this? All right, let's talk about required minimum distributions, or RMDs. Oh, is it coming up or something? Is that okay? Had a whole talk about it. Well, we're going to talk about some strategies for how to deal with this in a minute. But first, we're going to define our terms. We're going to talk a little bit about what it entails and what we need to do with it. So when you put money into tax deferred accounts like an IRA or a 401k, you put off paying the taxes. And if there's anything you know about the IRS, eventually they want their money, right? They're not quite like the mafia, but they're kind of in the same, right, ballpark. And they're most, as some people have said, they're the most aggressive collection agency in the world, right? They're very aggressive, right? But anyways, they want their money. And because of that, eventually, if you don't take money out of your IRA, they're going to make you. And that's what the required minimum distribution is. Previous to 2019 and the CARES Act, the starting age was 70 and a half. Now the required beginning date is age 72. And you actually have until tax for the first RMD you take you have until tax time of the following year to take that RMD. After that, it has to be done within the calendar year that you're going to take it. As for how much that amount is, it does vary depending on your account size. But starting out, just to give you a ballpark, it's around 4% of what the account value is. And the way that they calculate this, they take your previous year's ending balance, they multiply it out based on a life expectancy, your life expectancy table, and then they determine how much you're supposed to take out every year. Like I said, it's around 4%. Now, what happens if you don't take the money out? There's a penalty of a 50% tax on the amount that you did not take out that you were required to take out. So it is not a fun thing. In fact, missing RMDs is like, in my business, unless we've tried and our clients just don't do it, that's like the cardinal sin of IRAs. You don't want to miss your RMD because it's just handing extra money to the IRA. It's already hard enough, right, to hand them that money. So adding an extra amount to that is just not a good idea. So make sure you don't miss your RMD. That's my short little summary of that. Now, a couple fun facts or some things that you'll want to, these are kind of answers to commonly asked questions, I guess, we get about RMDs. Some people ask, if you have multiple IRAs, can you have to take out of every one of those IRAs, or can you just take the total out of one? And the answer is, when it comes to IRAs, you don't have to take it out of each individual IRA. You can take a lump sum out of one. As long as it meets the total number between all of them, it'll meet the requirement for the RMDs. The same does not apply though for 401ks. So if you happen to have multiple 401ks that you left after work, you will have to take your RMDs out of each separate of those accounts. Another question I get quite a bit is, if I take extra from my RMD this year, can I just knock out the next couple of years and not have to worry about it? Unfortunately, that is not the case. Unfortunately, you do have to take one every year once you reach that age. Now, taking extra out 1 year does have an impact on the next year because it will change your balance, right? And so if you take a whole bunch out, then the calculation is based off of the end of your balance, which will be lower because of that extra withdrawal. So it does have an impact, but it's not going to count toward your next year's RMD. Correct. Technically, you can take it at any time, but you get an extra 10% tax penalty on top of what you already owe in taxes. But past 59.5, it's just ordinary income tax. And then, like you said, at age 72, that's when they start requiring you to start taking money out. Set up your RMD. Honestly, it's pretty simple. It's just contact your advisor, whoever's holding the account, request a withdrawal. I mean, at the most, it maybe take a week and a half to 2 weeks, but usually it's quite even a little faster than that, like a couple days to a week. All they have to do is, if it's invested, is liquidate the investments. Unless it's tied up in some kind of a weird investment that's hard to liquidate, then you should be able to just call and get it within a week or two. And some people set it up to be systematic. They want to take it a little bit out every month throughout the year. You can take a lump sum. As long as you reach the total by the end of the year, then you'll meet the requirement. Good question. Last point here is that there's no RMDs on Roth IRAs. Anyone know why? Yeah, you already paid tax, right? So you pay tax on the money when you put it in. So they say, we have what we want, take it out whenever you feel like it. And another advantage to Roth IRAs that I don't know if I had mentioned already, but as someone inherits a Roth IRA, it's tax-free for them too, as opposed to a traditional IRA where the inherited amount is all taxable as they pull it out. The Roth IRAs, taxes already been paid by the parent or the person that's left it to the heirs, and so it's going to be tax-free inheritance. Is nice. Yes. IRAs, because it's tax deferred and there was never any tax paid on it, it doesn't matter how big your estate is, it's going to be taxable. Yeah, it's always taxable because they want to get taxed at least once on it. If they can get taxed twice on it, they will. They'll try, right? But at least once they'll require that. Yeah, good question. Any other questions before we move on to giving strategies? Many people do. Yeah, you can elect withholdings. You know, technology does it all for us. You just set the percentage that you want, or just let your advisor know when you're taking the withdrawals. We have some that are scheduled ahead of time to make sure we don't miss them. But yeah, you can edit them. You can change your withholding amounts, state and federal, and yeah, whatever you'd like. Makes it a little easier to take care of the taxes that way. Any other questions before we talk about gifting? Like what? Okay. Yeah. Well, yeah, I mean, taking money out of inherited IRAs, if it's a traditional IRA, it's all taxable. It's Roth IRAs that are tax-free upon inheriting them because the tax has already been paid. And that's consistent for different states. Was there something else you were thinking of, maybe? Yeah. Well, yeah, I mean, when a loved one passed away and you inherit, there's a lot of stuff to deal with. I mean, and they have account here, they have they have a life insurance policy. I mean, it's all handled a little bit differently too. Yes. Correct. Right. That's right. I'm talking about general rules when it comes to federal. Maybe that's what you were talking about too. So yeah, thank you for clarifying. Oh yeah. Yes. Yeah. Sorry, I forgot. I'm the only one with the mic. It's weird, dealing with the virtual world at the same time. So yes. Inherited IRA. Uh-huh. Parent looking at an IRA inherited job. They're going to they have to take tax on the inherit that. And just a traditional IRA you're talking about, regular one. Yeah, because of the fact, like I said, that it's the income, the tax has been deferred on it, and if you don't take the whole amount out by the time you pass away, maybe you take some R&Ds out, but there's some left over. It's very common. Then as they inherit it and they take it out, it's like they take out $10,000. Then it's like they just took out an extra $10,000. And the rule in most cases for children, as they distribute that money from the IRAs, there's a 10-year rule. That was changed as part of the 2019 CARES Act. It used to be that you could do what's called a stretch IRA, where you could stretch it across their life expectancy. But now it's required to do within 10 years. So within 10 years, they don't have the ability to roll it into their own. There are some types of beneficiaries. I think it's usually spouse beneficiaries. And if they're within, also if they're within a certain age range, 10 years usually, that they have the ability to roll it into their own. But most cases, especially if it's a child, then they're going to need to take it out within 10 years. They don't have to take out a certain amount every year. It just has to be empty by 10 years. Does that answer your question? Oh, and I didn't repeat the question. I'm so sorry. I did it again. He was asking about the rules for beneficiary IRAs and how people that inherit those have to distribute the money. So, okay, great. Let's talk about some giving strategies. And because there's different types of accounts, there's IRAs, there's taxable accounts, there's just cash and things like that. We're going to talk about some different strategies with kind of each different one. So the first question that you might be asking yourself is, I've got this RMD, got to take it. Maybe I don't need it, but I don't want to pay the taxes on it. So how do I avoid paying some taxes on my RMD? So let's talk about one of the solutions, and that's qualified charitable distributions, or QCDs. So what these are is a distribution of taxable assets from your traditional IRA or 401k. From there, it has to go to, as the name suggests, a qualified charitable organization, and it must be a 501c3 as per the tax code. Why would you do this? The question is, well, the answer is that any amount that you distribute from your IRA as a QCD is not included as part of your taxable income. It's not a deduction, it's just never even included as part. So when you get your tax time, you'll actually show it on your tax return as an IRA withdrawal, but the taxable amount will show as zero. So you'll still get a 1099 form for it and all that kind of stuff, but it's excluded, which is a big benefit. And we'll show you why in just a minute. How much? There is a limit on how much you can do through a QCD. You can do up to $100,000 per IRA owner per year. So that could be up to $200,000 if you both have one in your own name. So that's QCDs. That's kind of the rules behind it. Yes.
Is so any amount up to 100,000. So what if your required distribution is less than that, but you choose to give more? All of that tax?
Yeah, that's right. It's all excluded. I mean, you don't have to do just up to your RMD amount. You could do more than that. That's totally fine. And honestly, you could do it before you reach 72 as well. You could start doing it as early as 59 and a half and not have any sort of issues with tax that way. So if you just know you're not going to need all the money, you're just going to want it to go to a good cause instead and not have to deal with the tax, then this is the way to do it. Great question. Okay. So we'll get into some reasons why QCDs are a good option. First one is simplicity. Talk about that. Second, you get a possibly even greater tax benefit versus doing a different strategy. And then third, there's some situations where too much adjusted gross income can actually increase your premiums. So this could help you stay within the threshold to keep your Medicare premium low. So we'll talk about that in a minute with the table that we'll show you. So we're going to look at two strategies here when it comes to taking money out of your IRA and giving it to a charity. There's kind of two ways to do it. First is distribute and donate. What that means is you take money out of your IRA, you have the money be taxable, and then you go ahead and distribute, write a check to the charity of your choice. So this is kind of what it looks like in a flow chart here. You distribute the money to your bank account. Withdrawal amount is taxable income. You send the money to your charity, and then you get a deduction for the amount that is distributed, which is great, right? That's a good way to do it. Not necessarily the best way, but it's a way to do it. So now let's look at doing a QCD with this same scenario. It's a lot simpler because you distribute the money directly to the charity, and it never even gets included as part of your taxes. Now, we've had some questions before. Some people like to take the check themselves and hand it to the charitable organization. It's just, it feels better for some people, right? And so they asked, can I do that with a QCD? Because it's not technically going straight to them. Well, as long as the check is made out to the qualified charitable organization, it doesn't matter. And you can take the check yourself and still get the benefit of doing the QCD. Still have that option. Yes. Because of the increased standard deduction? Yeah. Yeah, and this is, well, I'll show you why in just a second. This is a great way to do it because you can get the benefit of the QCD and the standard deduction almost at the same time. That's what the next slide is actually. But you're right, it did make a big impact on that. Yes.
So we museums have just done investigating in a tool that sort of helps people automate this too, and you still want to go through your financial advisor also, but and it's not even if you just want to donate, you can use it to donate anywhere. But if you go to our website, there we now have a tool that basically helps you fill out all of the paperwork you need for your account.
Great. That's cool. Awesome. So this is one benefit. First of all, it's simpler, I think, because you don't have to go to the bank and then write a check and then go from there, which isn't that hard, but it is a little bit simpler. So now let's look at the possibly greater tax benefit. And this is where your comment about standard deductions changing with charitable distributions, the contributions and all that comes into play. So this is a hypothetical situation, right? So this isn't necessarily exactly what yours is going to look like. But if you happen to not have enough deductions to itemize, then this is probably going to be something you want to think about. So when it comes to the whole distribute and donate strategy, let's just say that you have $75,000 a year in income. And then you take a $50,000 IRA withdrawal. Maybe that's what your RMD amount is. From there, your total income is going to be $125,000. So then comes to tax time, and we sit down, we see the total income of $125,000, but don't worry, we made a contribution to charity with that $50,000. And so now that deduction comes in, and your taxable income in this hypothetical, without all these other factors maybe, is $75,000. So it's like it didn't happen. Not bad, right? There's a better way to do it though. Let's look at the option of doing it with a QCD. Your income is still $75,000. You still take the $50,000 out, but it never gets included as part of your taxable income. So the income is $75,000. Then you get your total taxable income down here for your tax time. And now you use the standard deduction, which in the year 2022, if you're over age 65, is $27,300 for a married couple filing jointly. At this point, with that extra standard deduction, almost on top of your QCD that you did, your taxable income now is $47,700 instead of $75,000, because you're leveraging the power of the standard deduction while also excluding that charitable contribution from your income in the first place. So this is how you can have a greater benefit tax-wise by using a QC, doing a qualified charitable distribution instead of a distribute and donate strategy. Okay, last one here is Medicare premiums. So if you're already paying Medicare premiums, you know there's different parts to Medicare. Medicare Part B is the one you have to pay a premium for. And depending on your income, your adjusted gross income, there's a possibility that you could have to pay a little more in premium. It's an adjustment that's made. And I know I wasn't going to tell you, I know I said I wasn't going to show you tables. This is the only one I'm going to show you. And it's just because it's easier to just show you this way. So this is what the income limits look like for adjusted gross income and the possible adjustment you might have to your Medicare premium if you do in fact exceed those limits. So you can see on here, we have for single filers up to, if you're making more than 97,000 adjusted gross income or more than 194,000 for joint, then that's the point where you might start having additional premiums. And as I showed you in the previous slide, because of the fact that you're excluding it from your income in the first place, you're most likely going to be able to help keep your adjusted gross income lower and therefore possibly save yourself some more premium for Medicare. Correct. Yep. The question was, is your RMD part of your adjusted gross income? And it's included as part of your regular ordinary taxable income. And then from there, they take the deductions out of it to determine AGI. Yes. Correct. So the question was, if you take it out of a Roth IRA or Roth 401k, does it get included as part of your adjusted gross income? And the answer is no. It's all tax-free. It's never included. Okay. All right. Any other questions about giving from or doing qualified charitable distributions or from IRAs? Yeah.
So, I mean, you're
Yeah, if you're going to be doing it anyways out of your IRA, if you happen to have enough savings and you're on track without that money that you're going to take out, then yeah, do it. You don't need to wait to have an RMD to do a QCD. You could just do it before then.
My question makes sense, take it out of an IRA that you're going to wind up paying taxes on now.
Yeah.
If you're giving that contribution anyway out of your regular income, makes sense to do it out of IRA because, like I say,
It's coming down the road anyways.
because you're using the standard deduction anyway, you're not able to itemize things like that.
Yes,
So
that's
it
right.
makes sense for large contributions to take them out of the IRA rather than take them out.
Yeah, I mean, if the intent is to give it all to charity, then 100%. That's a better way to do it. I mean, the question was about taking out of an IRA versus just your regular income or something. And if the intent is to give the money to charity, you don't have to wait till age 72. Okay, next we'll move on to a different kind of category of investments, and that's taxable accounts. So most of us have some sort of an IRA or a tax advantage account, but we also only have certain limits on what we can put into those. And we can't do huge lump sums into those accounts a lot of times. So people will open up taxable or non-retirement accounts, and that's very common. We have a lot of that. In fact, it probably makes up almost half of our assets that we invest and hold for our clients. So the question is, what's the best way to give money from a taxable account? We have a couple strategies to show you here. So the first one is liquidate and donate. And what that looks like is within your taxable account, you liquidate or sell some investments, you get the cash from that investment, and then you send it off to the charity of your choice. Of course, it's a great thing. You definitely get the warm, fuzzy feeling from giving to a charity, but that's just one strategy. The next would be a direct transfer to charity. So not a lot of people know, within your taxable account, you can take a highly appreciated asset like a stock or even a bond or something like that. If it's appreciated quite a bit over the course of more than a year, you can take that asset, instead of selling it, you can go ahead and donate it directly to a charity if they happen to have a brokerage account that can receive it, and then they can sell it. I think the Museum of Idaho, to my understanding, does have a brokerage account like that, and you can take those securities and you can transfer it directly to that brokerage account. And the biggest benefit of this is you don't just get a deduction based on the amount of the value of the security, but you also don't have to pay capital gains on the sale of that because you never sold it. You just transferred it over. So it's a benefit that way. The last strategy has to do with donor advised funds. And if you're not familiar with these, it's basically an account that is opened up for the sake of donating to, and then from there they take that money, that security, that stock or bond that you have, they liquidate it, and then they send cash grants out to the charity. And the reason why this might be used versus the direct transfer is if the charity you want to donate to doesn't have an investment brokerage account to transfer those securities into. And so instead, you can still get the benefit of not selling the investment. You just put it into that account, and then they will issue the money in the form of cash as a grant to the charity or charities of your choice. Does that sort of make sense? How often when does the money get distributed for grants? As often as you would like. You have control over the account. So most people do it right away, but technically you could wait until the following year, or, I don't think there's even a finite time when you have to distribute the money from those. Yeah. Yeah, for the tax credit, yeah. I believe so. I mean, that's one I'm not quite sure about because the Idaho tax law, I'm still not 100% sure on all those. I mean, and that's probably something you want to check with your accountant anyways, but I imagine it's the same. we'll just have to check on that to know for sure. That's a good question though. Okay, so I'm going to show you kind of some visuals to help you kind of see how this flows and see the difference between these when it comes to saving on a little bit of taxes. So let's look at the strategy of liquidate and donate versus a direct transfer of a stock or a bond or something into a brokerage account for the charity. So let's just say you have some Google stock. I know it's Alphabet is the name technically of it, but we're just going to say Google, right? And let's just say that your cost basis is $25,000. And cost basis is essentially what you paid for the stock when you first bought it. So the current value, since it's grown over the years, is now $50,000. And your intent is to liquidate and donate. So you liquidate the investment, turn it into cash. And from there, you go ahead and donate it to the charity. It's a good thing. The contribution to charity, because of the fact that you liquidated it, you now have to deal with some capital gains. So the $50,000 that it was, if you're going to set aside some money from that to pay for the capital gains tax, is going to be a little less than $50,000. So already the charity is missing out on some of that. The deduction is going to be whatever you donated to the charity. So in this case, it'll be a little bit lower than the total $50,000. And the capital gains tax, which is the difference between what you paid for it and what it's worth now, is $25,000. That's not what you're paying in tax, that's the capital gains. And the tax that would come from that, assuming you're at a 15% capital gains tax rate, would be $3,750, which is what's deducted from this total $50,000. So not a bad way to do it, but not necessarily the most efficient way to do it either. If we look at a direct transfer though, not only is it simpler, it only takes one step. You go ahead and transfer it directly over to the charity's brokerage account, but you also still have that full $50,000 because you don't have to pay any capital gains, and the tax is zero. So it's a more efficient way. It's better for you because you don't have to pay the tax. It's also better for the charity because they get the total amount that you intended to give them in the first place. An extra bonus to doing it this way, if you are a regular contributor to your taxable savings, is that if you are taking some stock that you have highly appreciated, it's grown a whole bunch, and you're taking the most appreciated stock and donating that and then buying back in every year, slowly over time, as you're buying at the higher level, your cost basis is in the whole account is going to start to go up and be higher. So down the road, when you're trying to sell some of your investments because you need money for one thing or another, your tax burden is going to be lower because of the fact that you've been getting rid of these older stocks that have been appreciating for years and years, and you're in a better position that way. So just an extra bonus if that's how you do it. Just to review the last option here, again, this is mostly for people that don't have a charity that doesn't have a brokerage account to donate the stock directly into. Putting into a donor advised fund is another option for you. So same scenario, cost basis is $25,000, current value is $50,000. And we take that Google stock, we put it right into the donor advised fund. From there, the fund administrator is going to liquidate the stock for you at some point, and then they're going to issue that cash grant to the charity. Oh, what happened to my... Oh, there we go. I was out of order. I don't know what happened there. It's like, no more charity. What? That's not happening. Okay. So, and then going back to this, you're still giving $50,000. The tax benefits of this is the same as a direct transfer. It's just another way to do it if you need that vehicle to help liquidate it without the capital gains tax. Capital gains, again, is zero. So any questions about the differences between doing any of those different options, direct transfer, donor advised funds, or just liquidate and donate? On the donor advised fund? No, you can choose multiple different charities. There's no one specific. You just open it up with the intent. It has to be distributed to a 501c3 in the future. But you don't have to name when you open the account. You don't even necessarily have to know who you're going to send the money to. You can figure that out later. but the year that you put it into this account is the year that you get the tax benefit, not when it gets sent out. So that's a little bit different than the direct transfer that way too. Any other questions on this? I'm so bad. I'm remembering to repeat half the questions, and then I apologize for everyone on the Zoom call. Okay, lastly here, when it comes to donations and charitable contributions, sometimes people just want to pay cash and just take it out of your bank or whatever, and they want to know what's the best way for me to do that. So I don't know if you've ever heard of the term batching when it comes to your tax deductions. If you don't have a lot of itemized deductions in the first place, like you said, the standard deduction kind of just does it for most people. But for people that are regular givers annually, and maybe they're not quite giving enough in 1 year to meet that, this could be a good strategy. So what some people might want to do is, let's just say you want to give $20,000 a year to charity. And this is maybe what they're not really thinking about it. They're just saying that's a good amount. I want to do this. Great. So in 2022, 2023, 24, and 25, they give their $20,000. In 2023, coming up, not this year, but next year, the standard deduction amount is going to be $29,200. So if they're planning on trying to get an extra benefit, this isn't going to do it. It's going to be no better tax-wise. Of course, you're still going to get the benefit of donating to charity, but tax-wise, it's going to be no better than just taking the standard deduction. So what I propose instead is to batch or kind of bunch your contributions together. So instead of doing every year within the calendar, you do every other year. And for you, if you decide to do it just right, I mean, let's just say you want to give every year in January and you do your $20,000 there. Instead of waiting until the next January, do it in December of the same year. It's only a month apart. It's pretty much the same thing to you. But when it comes to taxes within the same taxable year, now you have $40,000, and that's going to get you above that standard deduction. And so now you're going to get an actual tax benefit from doing it. So if you're itemizing, and this doesn't just have to be done for charitable contributions. You can do this with any sort of deduction. If you stack them in the right time and get above that standard deduction amount, you're going to get an additional benefit from doing it this way. So that's just an extra strategy when it comes to paying cash, or if you're just taking money out to pay to charities. Okay, last thing really quick here, personal gifts. I don't know if you're familiar with the personal gifts, the gift tax. If you pay above a certain amount, or if you give us above a certain amount to an individual, then you're going to be subject to pay, the giver is subject to pay the gift tax, which is a bummer. This is a strategy though, if you stay below the limits and you're giving money to, let's just say, your heirs, especially if you are thinking that if you're coming up on the estate tax total amount that you might have to deal with when you pass away, or even if you just want to make it simpler or start the process a little earlier, if you have extra cash and you think your heirs could benefit from it, this could be a good thing to do. The limits in 2022, and I believe these just went up to 17,000. I'll have to double check on that for the year 2023. But for an individual, you can give up to $16,000 to each recipient. And there's no limit on how many recipients you can have. You can give $16,000 to each child, each grandchild, each neighbor. I mean, I don't know how generous you're feeling, but you have options if you really want it. And so that's what it looks like per taxpayer. Per married couple, it doubles. So it's $32,000 per recipient. And again, no limit on how many recipients you can have. You can be as charitable as you'd like. So this is just going to be a quick summary of what we talked about, some of the takeaways that I hope you had. Yes?
So those are the limits you can give without having to pay tax.
Without having to pay gift tax, yeah. And right, if it was income, yeah, but if it was already been taxed, it's been sitting in your bank for years and you decide you want to give it, if you give too much within a given year, to the wrong, any given person, then yeah, you'll have a gift tax, which is that's just a dumb rule, right? So let us be charitable. But no, they like to get their money, the IRS. Okay, some takeaways, and then we'll just have time for a few more questions if we have them. Like I said before you put into taxable accounts, maximize your tax efficient savings accounts like the IRAs, the 401ks. Of course, if you can't put money in anymore because you don't have earned income, you kind of have less options. But if you still have the option, take advantage of it, because tax advantage savings make a big difference in the long run. Be intentional about your giving. It's great to give, and we know everyone that gives has a great heart, but take care of yourself in the process too by doing it in the most tax effective way. And I'm sure the museum, the charities that you do it to, they want you to do it in the way that's best for you as well. They're also looking out for your interests, and they want you to do it in the most effective way. Contribution limits, tax figures, deductions, all those things, they're getting a big boost. They're getting a big increase this year. Even tax brackets and things like that, if you haven't looked at them, have changed. Social Security is getting a significant increase, 8.7%, starting next month, which is exciting, but also we know it's because of inflation. So that's something to keep in mind. And then last, make sure, as I said before, you surround yourself with knowledgeable professionals that you can trust. Build yourself a team, surround yourself, and then don't have them fight against each other. Have them work as a team so that they can do what's best for you and maximize your potential as an individual and as a couple. So that's the main content of what we wanted to go over today. Open to any more questions. If you'd rather send me an email, if it's more of a personal thing, we can follow up after the fact. Are there any more questions just in general about the strategies or things we talked about today? Okay. Thank you guys for coming. I appreciate your time and hope you have a good one. Here's my fun disclaimer I have to put on there too, my disclosures.